Open your payment app. Look at the balance. That number is not money, it is a promise. And the money it promises is somewhere else, doing something. Here is what PayPal says in its own user agreement. Quote, PayPal owns the interest or other earnings on these investments. You will not receive any interest or other return on the funds held with PayPal. Read that again. They wrote it down. It is not hidden. It is in the user agreement under the heading about your account. Your balance is out there earning. Somebody is collecting. It is not you. And in Europe, if that company wanted to pay you the interest, it would be breaking the law. 3 questions. Where does the money go while it sits? Who is legally allowed to keep what it earns? And why does a payment that clears in seconds take 2 days? Start with the law, because the law is stranger than the conspiracy. The European e-money directive, Article 12. Quote, Member states shall prohibit the granting of interest or any other benefit related to the length of time during which an electronic money holder holds the electronic money. Prohibit, not permit. Prohibit. The United Kingdom copied it in 2011, and in July of 2025, the United States signed its own version into law for stablecoins, a prohibition on interest. 3 jurisdictions, 16 years apart, same sentence. Nobody is stealing from you. The statute simply says the money you park cannot pay you rent. Now, put the other half of the law next to it. The same rule books tell the company what it must do with your money. Europe says it must be invested in secure, liquid, low-risk assets. The new American stablecoin law is even more specific. It lists them. Treasury bills of 93 days or less. That is short-term government debt. Repurchase agreements. That is overnight lending between banks. And accounts at the Federal Reserve. Every single one of those pays interest. That is the whole point of the list. So stack the 2 rules and look at what you get. The law orders your money into interest-bearing assets. The law forbids that interest from reaching you. That is not a loophole. That is the design. How much is this worth? Wise is a money transfer company. It publishes its accounts. Interest earned on customer balances. The year ending March 2022, when interest rates were near zero, £3.9 million. The year ending March 2025, £594.3 million. Same company, same customers, same product. Nothing was invented. Rates went up 150 times. Adyen, a payment processor, tells the same story. Finance income of €29 million in 2022, 349 million in 2024. None of these companies did anything wrong. They followed the rules. That is the entire point. Now, at this point, a fair question. Is there a company that just gives it back? There is one. And what happened to it is the whole story. Wise, the money transfer company, wrote a policy into its annual report. It said, above the first 1% of yield, we aim to keep 20% and return 80% of the interest to our customers. Written down, audited, a public promise, with a number attached. So how did they do? Here is the sentence from the report. In the year, they aimed to return £355 million to customers. They managed to pay £161 million, 45% of their own target. And they explained why they missed it. Read this slowly. The deposits are in jurisdictions where we are unable to pay interest or cash back for regulatory reasons. The United Kingdom, which made up 2/3 of the shortfall. The company wanted to give it back. The company had a written policy to give it back, and the law in its own home country said no. Cashback paid to British customers. 0. Not because Wise kept it, because Wise is not allowed to hand it over. Now the purest example on earth. Circle issues a stable coin. You give Circle $1. Circle gives you a token worth $1. Circle takes your dollar and buys treasury bills. Here is Circle's own filing. Quote, reserve income earned from the management of Circle stablecoin related reserves represented 96% of our total revenue. 96%. That is not a business with a float on the side. That is a float with a business attached. The reserves, last year, about $75 billion. The interest on it, $2.6 billion. The amount paid to the people who put the dollars in, 0. Not because Circle is greedy, because clause 4A11 of the law that governs it says a permitted stablecoin issuer may not pay interest to holders. Which brings us to the second question. Why does it take 2 days? Not because it must, because the wait is a product. Stripe processes payments for millions of businesses. Standard settlement in America, 2 business days. But Stripe will also give a business its money in minutes. That option has a price. In the United States, 1.5% of the money. Square does the same thing. Next business day for free. Instant for 1.95%. Sit with that. The company proves it can move the money in 30 minutes by selling you the 30 minutes. The delay is not a technical limit. It is inventory. So let us go back to the 2-day wait, because there is one more thing about it that nobody tells you. The money does not travel slowly. The money travels on a schedule. In the American ACH system, the pipe your salary and your rent go through. There are cut-off times. Published ones. If your bank submits the payment before 10:30 in the morning, it settles at 1 in the afternoon. Before 2:45, it settles at 5. Before 4:45, it settles at 6. And if it misses all 3, it waits until 8:30 the next morning. Now look at what that actually is. The payment is not crawling through a cable. It is sitting in a queue, waiting for a clock that a committee agreed on. Every one of those cut-off times was chosen by people in a room. The delay is not physics. It is a meeting. Now let me take something away from you, because a diagram that only cuts one way is a bad diagram. You have probably heard that when a bank puts a hold on your deposited check, it earns the interest while you wait. That one is false. The American Regulation on Funds Availability, Section 229.14, requires the bank to begin paying you interest no later than the business day it receives credit for the check. The hold takes your access. It does not take your interest. So the check hold is not the leak. The real leak is much bigger. It is written into the law. And the companies collecting it print the number in their accounts every single year, where anyone can read it. So why does the law forbid paying you interest? The stated reason is this. If your app balance paid you interest, it would start to look like a bank account. And a bank account is a serious thing. Banks need a license. Banks get inspected. Banks have to keep money in reserve in case everyone shows up at once. So the rule exists to stop a payment app from quietly turning into a bank without any of that, which is a real problem, and the rule is a real answer to it. But look at what the answer produced. Your money must be invested. The returns must not reach you. And the company in the middle keeps what the rule created. Regulators solved the risk. The interest was left on the table. Somebody picked it up. That is the same shape we found in Australia. Fix one thing, and the machine adapts around the thing. So, where does your money go while it sits? Into government bonds, into short-term loans between banks, into an account at the central bank. Who keeps what it earns? The company holding it. Legally, openly, in writing. And why the 2-day wait? Because the wait has a price, and they will happily sell it back to you. None of this is a crime. That is what makes it worth understanding. You cannot fix a machine you think is a robbery. If the diagram helped, like it. That is the signal that puts it in front of the next person. And subscribe. YouTube will not show you the next one otherwise. One last thing. Everything you just watched was about money sitting in a payment app. A place that is not a bank and is not allowed to pay you interest. But your bank is a bank, and a bank is allowed. So your bank does pay you. Last year, one of the biggest banks in America paid 4.93% and 1.39%. Same bank, same year, same country. The difference was not the bank. The difference was you. That's next.